Welcome to Unit 3, Accounting Analysis. Have you ever wondered whether a company's financial statements truly reflect its real performance, or are they sometimes crafted to present a better picture than they really should? This week, we examine accounting analysis, the second tool in our financial analysis framework. We'll explore how well financial statements reflect the underlying economics of a business and whether we can rely on them to make informed decisions or whether we need to dig deeper. Last week, we focused on business strategy analysis, looking at how a company makes money. Now, we shift our attention to how well that business strategy is captured in the financial statements. What do we mean by accounting quality? Accounting quality is not a one-size-fits-all concept. It depends on who's using the financial statements. Investors might define it as accounting that helps them predict future cash flows. Lenders, on the other hand, may value more conservative accounting that protects against downside risk of non-payment on a loan. A key subset of accounting quality is earnings quality. That's the degree to which reported earnings reflect the company's real economic performance. If you look at the document on earnings quality that I've put up on Moodle, you'll see that even CFOs have different ways of defining it. The takeaway? There's no single definition of accounting or earnings quality, but it's crucial to assess. So what drives variation in accounting quality? Well, several factors influence whether a company's financials accurately reflect the business performance. Chief amongst those are the accounting rules. These dictate how transactions are recorded and summarized. For example, listed companies follow accrual accounting, meaning revenues and expenses are recorded when they are earned or incurred, rather than when cash is received or paid. This gives a more accurate picture of performance, but it also gives managers discretion over key estimates. Managerial discretion is another factor. Managers make judgments about things like when to recognise revenue, how long assets are going to be used for, and what provisions to set aside for future expenses. These estimates can be useful and informative, or they can be misleading if they're used to manipulate earnings. There are also incentives to manipulate earnings. Managers may have reasons to present financials in a particular way. These include meeting analyst forecasts to help maintain share price, smoothing earnings to reduce volatility, managing key financial ratios to comply with debt covenants. Sometimes it's not managers' discretion, but the accounting rules themselves that distort the underlying economics. A great example is R&D accounting. In the US, all R&D costs must be expensed immediately, even if they generate future value. Under IFRS, companies can capitalise some development costs, creating a different picture of performance across jurisdictions. How do we analyse accounting quality? Well, as analysts, we follow a structured process to evaluate a firm's accounting choices. First, we identify key accounting policies. We're going to focus on the 2 to 3 policies that are most critical to the business model. For example, in retail, inventory as accounting is a key policy, while in biotech, it's R&D capitalisation. Then we'll assess accounting flexibility. We'll determine how much discretion managers have. We'll evaluate the accounting strategy. We'll compare it to industry norms. Is the company being aggressive or conservative compared with its peers? We'll analyse disclosures. Do management provide clear explanations, or is key information buried in the notes to the statements? Then we'll look for red flags. Common warning signs include earnings that don't align with cash flows, sudden changes in accounting policies, and accounting choices that differ significantly from industry peers. If you suspect the financial statements don't reflect reality, you can adjust them. Both managers and analysts frequently recast financials, making adjustments for one-off items, accounting policy differences, or unusual estimates to get a clearer view of performance. We'll think about this in more detail when we're looking at non-GAAP metrics next week. So why does this matter? Accounting analysis helps us see beyond the reporting numbers. It lays the foundation for the next step in our framework, financial or performance analysis, where we use ratios and trends to assess firm performance. So as you think about your major project company, ask yourself, how does the company make its money and what are their biggest costs? Secondly, do their financial statements truly reflect the economic reality or are there distortions that you need to correct?